Thanks for joining us at XM.com. This is a preview video. Fed officials will be heading to Jackson Hole for their annual symposium this week. I'm Christina Marujos. With me today is Marios Hadjikyriacos, Senior Investment Analyst. Marios, in the past, several Fed leaders have used this venue to signal important policy shifts. Do you think we'll be getting such an announcement this year as well?
Hello, Christina. I don't think we're going to get anything huge. So in the past, this venue has been used. Even last year, Jerome Powell used it to signal that they will be raising interest rates very aggressively. And we actually saw some big market reactions following this symposium. But I doubt we are going to get anything so drastic this year. So let's take it from the top. The US economy is actually doing really well. The last time we heard from Jerome Powell 3 weeks ago at the July FOMC meeting, he preached data dependence. He essentially said that we've already raised interest rates quite a lot. We could raise them again, but for the time being, we're just going to monitor the data and decide what we're going to do next. So he basically put two options on the table: keeping interest rates at current levels for some time or raising them again a little bit. Now, as we speak, Christina, the markets are pricing in only a 15% probability for another rate increase in September. That, I think, is quite low, considering that the data we have been getting in recent weeks has been exceptionally strong. The Atlanta Fed has a model that estimates GDP growth, and for the current quarter, this model points to GDP growth of 5.8%, almost 6% in annualized terms. The US consumer is still doing really well. The labor market is in great shape. The unemployment rate is near a 5-decade low. And very importantly, we've seen home prices hitting new record highs in many parts of the country lately. So the cool down in rents that the Fed has long awaited might prove to be elusive. So to sum all of that up, the US economy is very resilient. It's still running hot, and with energy prices also moving higher lately, there are concerns that inflation might not return to its 2% target anytime soon. So going into the Jackson Hole meeting, I think that the most likely outcome is for Jerome Powell to keep his options open. There's been serious progress on the inflation front lately, but core inflation is still at 4.7%. As we mentioned, there are several elements that suggest it might remain elevated. So it's just too early for the Fed to take a victory lap and declare mission accomplished. Now, Powell was preaching data dependence 3 weeks ago, and he'll probably maintain that approach. However, considering the strength that we've seen in recent data, I think that the risk is that he strikes a more hawkish tone this time. He might emphasize the prospect of keeping interest rates high for a longer period of time. And if he does, that would likely put even more upward pressure on US yields. Long-dated US yields, the 10-year, the 30-year, those broke to new cycle highs this week. So if Powell strikes a hawkish tone, that could put even further upward pressure on yields, and that, I think, would be, could influence a lot of assets.
That brings me to my next question, Marios. How could Powell's remarks impact the dollar this week?
Well, look, the dollar is, if Powell strikes a more hawkish tone and we see US yields moving even higher, that's good news for the dollar. It makes the dollar more attractive from an interest rate perspective. And in this sense, dollar-yen, the pair, tends to be the most sensitive to interest rate differentials because the Bank of Japan hasn't raised interest rates yet. So higher US yields would probably be reflected in a higher dollar-yen. Now, overall, as far as the dollar goes, Christina, I think that the picture is quite bright. US yields are breaking out. That's making the dollar more attractive from an interest rate perspective. And at the same time, on a simpler level, the US economy is just stronger than its competitors at this point. China, we're all reading headlines every day about how the economy is struggling. In Europe, business surveys suggest that the economy is either stagnating or heading for a mild technical recession. So just by comparison, the US dollar just seems more attractive, both from an interest rate perspective and from a growth perspective. And I suspect that will be reflected, that will be increasingly reflected in the currency market as we move forward.
I see. Marios, thanks so much. This was a preview video. Thanks for watching at xm.com.